Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at DKNG, or Draftkings Inc. DKNG is an American daily fantasy sports contest and sports betting company. Here's the barchart.com technical opinion rating for DKing. The bar chart rating is an 88% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to market select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that Draftkings, has been above the moving average line all year, so the monthly trend in DKNG is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The chart shows that the blue line has been above the green line since February, so the daily trend in DKing is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. Draftkings is near the midline of the Keltner channel, so DKNG is inside the buy zone. Since the trend is up, we want to buy a call. DKNG has plenty of option chains to choose from. We're going to use the January 19 option chain. Right now, the Jan 19 options have 41 days to expiration. Here's the DraftKings option chain for Jan 19. DKNG closed at $35.90 on Friday. That means any calls on the list from 20 to 35 are in the money. Let's take a look at the profit potential for purchasing the DKing Jan 19 36 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 36 call is 2.6 to 2.11. We try to enter at the midpoint, so we'll use 2.09 as the buy price. Our call option calculator shows the profit potential for this call based on DKNG price changes at option expiration from flat to a 12.5% increase in price. We can see that if the DKNG stock price is flat at $35.90 at option expiration, the 36 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 30 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 30 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the DKNG stock price is up 1%, the 30 call will lose 3% of its value. We want that to be break even or better, so the 30 call does not meet our requirements. Let's see if the 24 call will work. The bid-ask spread for the 24 call is 11.65 to 12.25. We try to enter at the midpoint, so we'll use 11.95 as the buy price. The 24 call works. If the DKNG stock price is up 1%, the 24 call will make a 2.6% or $31 profit. That's better than break even, so the 24 call is the one we'll buy. The call option purchase calculator also shows that if the DKNG stock price increases by 2.5%, the 24 call will make a 7.1% or $85 profit. If the DKNG stock price increases by 5%, the 24 call will make a 14.6% or $175 profit. If the DKNG stock price increases by 7.5%, the 24 call will make a 22.1% or $264 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the DKNG stock price is does not make the expected move up and remains flat at expiration, the 30 call will only lose minus 0.4% or minus $5 compared to the 100% or $209 loss for the 36 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the DKNG Jan 19 30 strike call and sell to open the DKNG Jan 19 35 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 30 call for $6.45 and sell the 35 call for $2.65. $6.45 minus $2.65 equals $3.80. So the entry price or debit cost for the spread is $380. The call option spread analysis calculator picture shows that the spread will make a 31.6% or $120 profit if the DKNG stock price declines by 2.5%, remains flat, or increases in price when the options expire. If DKNG is down 7.5% at expiration, the trade will lose 15.9% or minus $59. Creating the debit spread will allow us to collect a $380 cash credit to our brokerage account. $265 cash credit to our brokerage account for the sale of the 35 call. As we said on the previous slide, this reduces the cost of entering the spread to $380. Here's a note regarding earnings reports. The next DKNG earnings report is scheduled for February 1st. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the DKNG Jan 19 24 strike call for $11.95. We also reviewed the spread. The spread said to buy to open the DKNG January 19 30 strike call and sell to open the DKNG January 19 35 strike call at a debit of $380. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.